Now we're going to be, this is where the real power comes in. And we're going to look at spreads, credit spreads, debit spreads, straddles, strangles, and back spreads.
Okay.
The first type we're going to look at are what's called vertical spreads. Those are the credit and debit spreads.
Now, where does that name come from?
Good question. It's so simple, it's just, it's truly amazing. Vertical spreads are options of the same type and same month, but different strike price. Now, we're going to look at the Cisco Systems options table in the Investor's Business Daily. And let's say we wanted to buy the 55 call for April and sell the April 60 call. Well, we're going to buy the 55 call for April. It's right there. We're going to buy that one, and we're going to sell that one. Well, look at what they are. They're right on top of each other.
Vertical.
Vertical.
Okay.
Or I could sell the 55 put for one, buy the April 50 put for a half. I would collect one, I would pay out a half, I would get a credit of a half. And that's a credit spread. It's a vertical spread. So now what we're going to do is see how these things work. First, what we're going to do is we're going to take a look at the real estate index and a call debit spread on the real estate. It's a vertical spread because we're going to buy options of the same expiration series, Junes. We're going to buy the same type, calls, but the strike prices are going to be different, 255 versus 275. We're going to buy the 255 call and sell the 275 call. Again, this is on the real estate index.
And you're looking for rising volatility in this case.
We're looking for rising prices and rising or steady volatility. In fact, if you just take a look at this chart right here, you can have, we would be satisfied if, and let me just change this to a pointer here, if we had this thing rise in this manner like this. We don't need a rise like that. If you were a call purchase, if you just bought a call alone, you might need that vertical, near vertical lift. But in our instance, we can make money going this way. In fact, we can make money on a lot less than that. I'm just going to look at these prices here, 255 plus 9. I'm going to cheat a little bit. All we need this thing to do is do this. And we make money. So we do not, we want it to go up because it needs to go up above 264. I'll show you how to calculate the break even in a second. It needs to go above 264, but that's all. So it's just a slight bullish bias. Here is our grid, our option price grid, and it looks familiar to what we've been looking at earlier, but now we've got two options here because we've got a combination. In this instance, we're looking at the real estate index, the June 255 call, sell the June 275 call. This option, the 255 call, is priced at 12. The 275 call is priced at 3. I'm not going to place an order to buy the 255 at 12 and the 270 and sell the 275 at 3. I'm going to say do this spread as a package at 9 or better. So let me tell you how I would place that order. I would say, Pete, I want to buy the real estate index. I want to do a call debit spread. I want to buy the June 255 call, sell the June 275 call for a total net debit of 9 or better. That means I'll pay $9 or some number less than that. And let's just take a look at how to value the option spread and how we determine our profit and loss. At 250, we would have the 255 call. Nobody's going to exercise their option to buy at 255 when they can buy it at 250 in the open market, so the call is worthless. Same thing with the 275 call. We paid 9 to get into the trade, so we've got a $9 loss right there. At 265, the 255 call, you could buy it at 255 and immediately sell it in the open market at 265, making 10 on that part of the transaction. So that option is worth 10. We bought it early in the initial part of the transaction, so to exit it in an offsetting transaction, we would sell it. When you sell something, you get money. So that 10 is going to be a plus to our ledger. The 275 call is going to be worthless at that point. So a plus 10 and a minus 9 are equal to a plus 1.
Okay.
Now, if we go all the way up to 275, our 255 call is worth 20. The 275 call is still worthless at that point, so we have a plus 11. Now, look at this profit and loss column, and notice that the number does not climb above 11.
Right.
And that's because, let's say we went to 300. The 255 call, you could buy it at 255 as is your right under the option.
Right.
Sell it for 300. You net 45 on that part. But we're also short a 275 call, which means since we don't own the asset, we would have to buy the index at 300 and then sell it to somebody for 275. So we would lose. The option has a value of 25, but in our position, we would lose 25. So we would have the plus 45, the minus 25, and then the minus 9 for putting the position on nets out to 11. So there's a shortcut way of taking a look at it, taking a look at profit and loss and risk and reward. The profit potential is the difference between the strike prices minus the debit that you pay. So the difference between the strike price is 20 minus 9 is 11. There's your profit potential. Your risk is the debit that you paid. Your risk is 9.
Okay.
And you can see that that follows. It never gets above 9.
So you know what your profit potential is and what your loss potential is.
Right. And as we'll show people later on, you can use the break-even to help you calculate probability. And that'll have a very valuable function later on.
Okay.
We'll discuss why it has a valuable function later on.
Right.
This trade, we don't have a result of that because the trade is open.
Oh, it's still on.
So,
Okay.
But this is what the risk-reward graph looks like.
Okay.
And you can see we're graphed here to minus 9 until we reach 255. Now it reaches the strike price of the option that we bought. That value is climbing, and then it eventually reaches the strike price of the option that we sold, at which point we've capped out our profits.
There's our ceiling.
There's our ceiling. So now if we just bought the 275 call, which would, so if we just bought the 255 call,
Right.
our break-even wouldn't be 264. I don't think we talked about break-evens. We talked about break-evens on call purchases.
Right.
Break-even on a call debit spread is the strike price of the option we bought plus the net debit.
Sure.
So that's 255 plus 9.
Right.
If we just bought the call, it would be 255 plus 12, which would be 267. So we
gain a little bit there.
Yeah, you're increasing the break-even and reducing your probability of profit. Here we're reducing our probability of profit. Here we're increasing our probability of profit by reducing our break-even hurdle. And what we're doing is we're giving up unlimited profit potential if this index were to go above, not above 275, it would have to go to 278 in order for us to start losing profit potential.
Right.
So that's a pretty, if we look back on this chart, it's never been to 278.
So
We make money here if it just goes to 264, and what we give up is anything above 278.
Yeah. Which
So.
looks